Good morning, ladies and gentlemen. Well, nothing to see in the risk dial. It's still very firmly in risk on, which basically means that equities are to be preferred to bonds and they will perform better over the long term. If we look at how they have performed since the last risk on, we can see that they are very much in line with every other period of risk on, and that equities will continue to outperform in terms of bonds. Nothing really much to see here, and basically continue to prefer equities on dips. Let's have a look at what the QRA actually was. So they've targeted the short to belly. As you can see, they've increased by actually more than I thought they would increase in terms of issuance, but they've reduced the duration of the issuance, i.e. they're targeting the part of the yield curve that the market likes. They've been masterful, targeting exactly where the market wants to buy, and they are not targeting exactly where the market is at the highest yield. As you can see, they've left the 20-year completely unchanged, which is the highest point in the curve, which we'll look at later. And they've basically increased the most between 2s and 7s, slightly in the 10s, and very, very slightly in the 30s by an extra billion. All the other shortfall, as they say, is going to be cash management bills, treasury bills, FRNs, tips. Very, very good. Exactly what the market was not expecting, but exactly targeting where the market wants to buy. And therefore the effect of the QRA was very much muted. Let's have a look at what the yield curve did, and certainly not what I expected them to do, but very, very well constructed QRA. These guys are good. If you click on yield curve, you can actually see what the latest yield curve is and why it makes sense to target what they did. They targeted the 2-year to 10-year area, which is exactly the area that the market wants to disinvert. And they haven't touched the 20-year, which is the highest point in the curve. And they've very, very slightly added to duration 1 billion per month to the 30-year. What that does is basically it anchors the 30-year slightly. It makes the 20-year quite attractive because don't forget they will also start doing buybacks. And the buybacks, I'm 100% convinced, they're going to be concentrated in this area. So they will be issuing probably more 30s and 10s to cover the purchase of these 20 years. So they will try to smooth out this kink in the curve over the course of the next 6 months or so. I expect the 10, 20s, 30s butterfly to actually go straight. And they've targeted exactly the area, the bulge here around the 5 years, which is now over time likely to go to flatten out unless we see some data which makes the curve disinvert. But they're targeting exactly where the market has been buying in anticipation of Fed cuts. And therefore, the market's reaction was very, very muted in terms of yield curve movements. The yield curve actually flattened slightly because they targeted exactly the area that needs to move down for it to steepen, which makes the steepening for now less likely unless we get some data that makes the Fed more likely to cut sooner and by greater amounts than the market expects. But since the market expects so much, they absolutely let it have it. And this is probably a concerted effort between Treasury and the Fed to slow down the pace of decreases in yield of this part of the yield curve. What it also did, and this is very important, is very much reduced the amount of bills they're going to be issuing. The amount of bills is going to be negative by about 300 billion compared to the last quarter. This means that the RRP will drain very slowly, if at all, and that means that any talk of QT being reduced anytime in the next 6 months, I think, is now dead. That means that QT will continue, and therefore the longer end of the curve should not rally much on that. It was a very, very well constructed QRA. To me, it means stability and a lower level of volatility in the whole yield curve for the next, I don't know, whatever, month or so, until and unless data comes in which shows us that the Fed needs to act. But for the time being, you sell volatility. The MOVE index actually did not go down last week, but that to me was a factor of New York Community Bank rather than anything else. I now anticipate that the MOVE index will stay either very well behaved in these ranges, or slowly it'll start going down. I really see no reason to buy volatility. To me, the best trades are buy rights or sell puts. And I'll just now have a look at the individual tenures to see where best to sell volatility. So what do we have next week? The really important data to me will be the revisions to CPI, because Waller told us what they're looking for. They're looking at the revisions to CPI to make sure that CPI really is for 2023 where the data said so far that it was. And then they're looking for a couple of data points from 2024's CPI to make sure that the trend is continuing. If the trend is continuing, Waller quite clearly said, and it was parroted by Jay Powell on Wednesday, that then they will be ready to consider the timing of the cuts. What does that mean to me? That means that if Friday is in line, then there is absolutely no reason to expect the 2-year to 5-year area or the 2-year to 10-year area, which is the one which was targeted by the QRA, to go much up in yield, because any other data that comes out which does not refute that CPI is where it was for 2023 and that the data points for 2024 are low, so you're looking for this Friday and then you're looking for Wednesday, I believe the CPI is, you are looking to basically sell volatility every time the market gets to this area in 2s and 5s and 10s. It's very, very unlikely that that part of the curve is going to go any higher than that, because there really is no reason for it. Once it gets to those levels, you are looking to either buy the market and sell calls, i.e. these levels, or you're looking to basically just get long, or sell strangles or sell straddles. The market is terribly unlikely to move out of this range unless the CPI is higher than they thought it was for 2023. I really foresee a period of stability whereby the market just trades in a narrow and ever narrowing range until we know that the Fed is ready to cut. Now, you're always going to get periods of volatility when and if you get some kind of a bank run like we did on last week. This whole move down and then, well, the back up is because of the NFP, but the whole move down was on the back of this New York Community Bank that nobody's ever heard of, and that is unavoidable. You will get that, but you've got to look through it because it was not a very important bank. certainly not systemic, and certainly not something that the Fed or the market should really care about for more than 1 or 2 or 3 days. And that's exactly what happened. The market came right back after the NFP because the NFP says that with this kind of economy, there is absolutely no rush for the Fed to cut. The Fed will cut, but only when they're good and ready, and the data points for 2024 confirm the CPI for 2023. In terms of the yield curve, basically it's steepening postponed. I do expect the yield curve to continue to flatten because that is the pain trade. Too many people have got the steepeners on, and therefore it's more likely to flatten to get them out of their positions, to stop them out. How much can it flatten? I don't think it can flatten very much unless the data on Friday about the CPI says that no, the CPI is not where the Fed and the market thought it was for 2023, and actually we are way above 2% on the 6-month average of core CPI. If that happens, then you will get a lot of flattening. And I would actually expect this 47 level on the 2s10s to get taken out. And on the 5s30s, you will definitely trade up around the 10 area. Why is that likely to happen? But only and only if you get significant upward revisions to the CPI. Well, because it just means then that inflation is sticky, and it's sticky above the Fed's target. And then you're talking about postponements of cuts, well, into the late summer, if at all. Don't forget that what they have is a problem with the election timing as well. With the election being in November, it's very unlikely that they want to cut just before the election or just after the election. And let's have a look at that. Let's have a look at when they could cut and the timing of the election as well. The Fed has 3 cuts penciled in for 2024 in their dot plots. If the revisions are higher, the likelihood of a March cut goes to 0. Now it's only 20%, so it's not very high, but it goes to 0. And May will also go to 0 because they just don't have enough time to get the data points for 2024 then that they need in order to decide on the cuts. That leaves the earliest cut in June, possibly one in July, and then I think September and November are zeros, and then all they have is December. This is because of the election. I think the Fed will hate to cut in September unless it has a very good reason to do so, i.e. an economic reason that nobody could interpret as political. Well, let's have a look at what that does to the various contracts. You can see that then anything between H4 and out to M4 is probably about 15 to 20 basis points rich. But where it really starts to matter is in U4. So if you see any kind of upward revision which is more than a 0.1, you are then looking to sell U4 and out. So UZ, because that is going to come down by at least 30 to 40 basis points. What does that mean? That means that the 2-year is the one that gets hit the most, and the 10s to 30s get hit least, and the yield curve basically flattens. At the moment, there's very little difference between what the US is doing and what Europe is doing. They are in the same phase, i.e. one of waiting and trying to find out when the respective central banks are going to ease, and if they're going to ease, and if they're going to ease by how much. So they're in the same kind of cycle the cycles are aligned, and therefore they're very much trading in parallel to each other, and the spreads between the two are not really moving. They're just trading spreads of 5 basis points up or down. So everything I've said for the US actually applies equally to Europe. It's very possible, if the US revisions of CPI are high, that the European market reacts in exactly the same way, and the bubble does go back up to these levels. I think they're going to be very good buys, but I'm just telling you it's absolutely possible that they follow. And the same flattening is evident in the German curve as it is in the US curve. So for example, 230s, you can see that it's slightly flattening as well as of this week. If you have a look at the 530s, you can see that certainly it's not steepening. It is quite likely to trade at these levels. It's just that these curves are flattening less than the US curve, but that's because they also have less supply at the 5-year area. So the supply is the difference between the less flattening in Germany and the more flattening in the US. But the overall tendency of the curves will be the same. I.e., I see nothing different in Germany than I see in the US. It's just a question of degree. So let's have a look at the differentials. This is 5s, Germany, US. As you can see, very stable, trading around, doing nothing very much. 10s, very much the same. I think every time it gets to this 182, 184 level, or even 186, you have to prefer Germany to the US. But otherwise, these are just trading ranges. And I don't think that anything here is going to break or give us a signal anytime soon. Certainly not unless CPI. If CPI revisions are high for the US, yes, you are likely to get a relative move upward in this price, i.e. people will favor the German curve, investing in Germany, because it doesn't have the same supply problem. But I think it's going to be very marginal, and I think that it's very much the same thing whether you are at the moment trading Germany or trading the US. I don't think it's going to move more than single figure basis points up or down. Having said what I've said about the differentials, it's not surprising that the dollar is actually very stable. I think the odds are that we go and trade this 104.20 to 104.50 area and stop everybody out over the course of the next few days, simply because the market has to do something. I think the downside at the moment is very well protected until we get the revisions to CPI. And then we might move depending on what the figures are. And if we have a look at the euro, to me, it's far more likely that we go and take out these stops around the 107.25 area, trade down to maybe 107, 106 something, and then reverse course and wait. Very, very unlikely that the euro is going to have a huge amount of strength anytime soon. To me, this kind of area, 106.70, would be the target. Everybody gets stopped out, and then we can possibly return to some bullishness. But I really don't see why anybody would want to prefer the euro to the dollar at the moment. And the second derivative of the Dixie and of the bonds, i.e. gold, is likely to do not very much either. The only reason why people would start preferring gold is if the CPI revisions get revised higher, and they might say, well, the Fed is unlikely to be as restrictive as it needs to be, and therefore rather than buy bonds, I will buy gold. But then bonds will be going up in yield, and that will be a headwind for gold. Tips will be going up in yield, and that will be a headwind for gold. The dollar will be going up, that will be a headwind for gold. But I think gold would outperform bonds and would outperform in general, but it's going to be limited to something like this high type of high, 2130, 2140. I don't see a huge amount of downside in gold unless we see CPI revisions which are lower than expected, and I think the odds of that are very much very, very low indeed. We have a very low CPI as it is. The revision can just confirm the low level, but if anything, it's more likely to negate it, right? And if it does negate it, I would have thought that gold would outperform bonds. But at the moment, I see gold being stuck in a range against itself, as it were, but possibly break a move to the upside in gold relative to bonds. Let's have a look at that. So this is a chart of GLD over IEF. So my logic is that it's going to break out of this range. If the inflation revisions are higher than the market expects, i.e. it shows that 2023 inflation was not as low as we had predicted, I would have thought that gold over IEF should go higher and return to about these levels. If on the other hand it's as expected, then why would you want to own gold, right? And then it should start breaking down. So that is my logic. Gold over tip, it's very much the same kind of chart. But if people start believing that the data points are false, then it makes sense for people to prefer to own gold rather than tip as well. Certainly at these levels. What I'm trying to say is that it should break out of this triangle at some stage for a reason. And the only reason that I can see for it to start breaking higher is because inflation revisions are higher. If they're lower, it would make sense for gold to break down. Now, what would that mean for gold itself? Well, it's a relative move. So we are not looking for gold necessarily to start moving up and spiking. We are looking for it to remain possibly stable while IEF and tip go down. So, bear that in mind. That is a relative move. And of course, I'll be tweeting about that because that will be very interesting for me next Friday. The one chart that absolutely does not fit with higher inflation is this DBC chart and also the oil chart, which we'll have a look at as well. This 2175 level is extremely, extremely important and has acted as big swings. You can see that when it broke back in 2014, there was just a cascade lower. And, I don't know what to say. It just does not make sense to me that this market should now be lower than when the invasion of Ukraine took place and looking very, very bearish. I mean, this could be a giant ABC, which would see it come all the way back down to these levels, 18 or something, which would be another 10-15% lower than it is at the moment. If it starts breaking this 2175, the minimum expected to trade is 2050, where it gets the support from the 200 weekly moving average. But you can see if this is an ABC, it does target this 2050 area. And that would mean not good things for oil, right? It would mean that oil probably takes out these lows and stops everyone out, probably goes down to something like 64. This kind of level here, and stops everyone out and then possibly retraces. But what would that mean for inflation? It just doesn't make any sense that the 2024 data prints that the Fed needs to start easing are going to be high, does it? When you triangulate everything that the market is saying, and a lot of what the market says sometimes is noise, it's that don't really expect much inflation in early 2024, and if you're not going to get that, then any kind of move on the revisions to 2023 is also likely to be noise and is likely to be muted, in which case the only thing that I can think of is actually to sell volatility in bonds. And everything that I see that makes sense to me says that you are supposed to sell upside volatility in bonds, i.e. that yields, if they do go higher, they're not going to continue going higher. And that level that we discussed, if the market goes up on the revisions, it's not likely to have follow through. It's likely to have buyers come out at those levels and return back into the range. The strength in equities continues unabated, but what I do find interesting is that it's all very, very overbought. And this is a monthly chart, and we're right on top of the monthly Bollinger Bands, and that never ever lasts. Or if it does last, it's reversed. To me, the very important level is 47.64, and as long as it's up there, it just means that any little technical move down towards it is just that. And it will continue, if not this month, then next month. Let's have a look at other charts. The 195-minute chart, which I like, it's overbought. It's likely to have reversals. I really would not be overly long here. I would just trade it. It's not in risk off. I mean, that's for sure. But what it is vastly overbought on every time frame, and it's technically vulnerable. I don't know what it's technically vulnerable to, but it's technically vulnerable. And at some stage, I would definitely expect a retest of this moving average, which slowly it'll go up. But I think anything up here is just too quick, too fast, too soon. Funnily enough, the only market that is in equities that is not above the monthly Bollinger Band is actually the strongest one, which is NDX. If we have a look at that, the Bollinger Band actually comes in at 18,000. As you can see here, it comes in at 18,028, and that is the only one that is not up there. At some stage, I expect it to touch it. I expect everyone to get bullsed up and touch the 18,000 level and for it to come back from there. So I just don't see that equities are going to go down. I just think there's going to be continued rotation into the QQQ and the NDX. And that tells me that it's unlikely that bond yields are going to go very much to the upside. I really see no reason to fade these current moves. I just think that SPX and the Dow have gone up too far too soon, and that if there's going to be a move up, it's actually likely to be in the NDX rather than anything else. And given what the earnings have been so far, you can see that all the upside is there rather than in the other markets. So what you could get is a move even higher in SPX that goes through the Bollinger Bands. This touches its Bollinger Band, and then some kind of event takes place that knocks SPX far more than it knocks NDX. But what that is, I really don't know. I just see that we are in a bull market at the moment. the outperformance is against the bonds. I don't think the bonds are going to go too much higher in yield. And if I don't see that, then I don't think that you're going to get that much of a knockback in equities. The international markets give no indication that they're ready to pull back as yet. And therefore, if they're not ready, I doubt that the SPX can go down very much. So this is the stocks, and it's broken this very, very important 45.79 area that it traded back, and I will show on a monthly chart how important that is. That's the high from back in 2007. To me, this indicates a market which in the next month or 2 or 3 is going to trade 48.50. And if this market trades 48.50, then because that is the very important level going back to 2002, I believe, I just can't see that this market can keep on going up while the other markets are languishing in any way. If you have a look at the Nikkei, that also had the second or third highest close of this move, still indicates probably that we are range bound, but certainly that does not indicate a market which could do anything but a quick ABC and then go again over the course of the next 2 or 3 months. And EEM is holding this 37.64 area, and it has a chance of going up towards this 42.25. I think it's quite interesting that we're getting a turn in the 200 weekly moving average. It could be nothing, but we've been in this area here of EEM for such a long time that I think buying some call options or call spreads, say 38.50 to 4200 for a couple of months, could be quite interesting. Why not have a few on board? We could get a real rotation towards EEM at some stage, and I just don't see that that is a particularly bad trade at the moment. But equities, you can see there just isn't anything there which says that we should head down and stay down. So I've included the QRA page for your edification. You should read it, and you should have a look at what the Treasury did and why it did it with my explanation. The only thing I'll be looking for next week are the revisions to the CPI, and then the week after the CPI as well. I don't think the markets, unless those figures are out of line, I don't think the markets can possibly go much higher in yield, especially at the long end, because the long end will be far less sensitive to anything that's going to happen next week early, i.e. the auctions of 3s and 10s, and then you have the 30s on Thursday. But I think the 30s are going to be quite well received because the supply is much less than we anticipated. After the first few days of the market maybe going up 2, 3, 4, 5 basis points in yield, I expect basically a reversal by the end of the week, and then we see what the CPI revisions are. Unless those CPI revisions are revised higher, I think the market is in a very good place for the longer term to again at some stage start looking for cuts, because I'm quite convinced that the Fed will cut unless the CPI reaccelerates. And given what DBC is doing, and really DBC's level is the one that must hold for there to be any hope that CPI can be any higher than people expect for the first quarter of 2024, then if that starts breaking, I become more and more convinced that the Fed will ease, and will probably ease not in March because that's too early, but will ease in May or in June, or at the very least they don't move their dot plots in March. and that will make me absolutely convinced that they will ease in May or June, and then we know what to do. Thank you very much indeed, and tweet you on Monday.